1%, half a percent, a quarter of a percentage point. These tiny numbers are quietly draining $1 million from your lifetime wealth, and you have no idea it's happening. Today, I'm exposing the small percentage decisions that cost you more than your house. The 1% differences that compound into 6 and 7-figure losses, and why the financial details you ignore are literally the most expensive choices you'll ever make. Let's get into it. Here's the thing about personal finance. Everyone talks about the big decisions: buy a house or rent, invest or pay off debt, go to college or learn a trade. But nobody talks about the decisions that look like rounding errors. The 0.5% here, the 1% there, the tiny fees buried in documents you never read. And those invisible percentages, they're stealing more money from you than almost any big decision ever will. Let me start with the most expensive small decision most people make in their entire lives, and they make it on their very first day of work: not negotiating your starting salary. 55% of workers accept the first offer without negotiating. More than half. They just say yes and start working. Here's what that costs. Researchers at Carnegie Mellon calculated that not negotiating your first salary costs between $1 million and $1.5 million in lifetime earnings. That's not a typo. $1 to $1.5 million. How is that possible? Because every raise you ever get compounds on your starting salary. Every percentage increase, every promotion, every bonus, they all build on that original number. If you start at $50,000 instead of $55,000, that's only a $5,000 difference, right? But with 3% annual raises over 40 years, that $5,000 gap becomes $377,000 in total lifetime earnings. At 5% annual raises, it becomes $600,000 to $750,000. One conversation, 5 minutes of discomfort, $750,000. And here's what makes this even more painful. 85 to 89% of people who try to negotiate succeed. The fear of negotiating is almost completely unfounded. When asked, 76 to 83% of employees receive what they request. 73% of employers expect you to negotiate. They build room into the offer specifically because they assume you'll ask for more. When you don't ask, you're literally leaving money they budgeted for you sitting on the table. 94% of negotiated offers remain intact. Almost nobody gets their offer rescinded for trying. You're afraid of a conversation that works 85% of the time and almost never backfires. And that fear cost $1 million. Now let me talk about investment fees, because this is where it gets sneaky. You've probably heard that index funds are better than actively managed funds. But do you know why? It's not just performance, it's the fees. The average actively managed fund charges 0.59% per year in expenses. The average index fund charges 0.11%. Some charge as low as 0.03%. 0.5% difference. Who cares, right? Here's who cares: your future self. A 0.5% expense ratio versus a 0.05% expense ratio on a $500,000 portfolio over 30 years means $515,000 lost to fees and foregone compound growth. On a $1 million portfolio over 40 years, that same difference erases $2.84 million. Let me say that again. 0.5% costs you $2.84 million on a $1 million portfolio. The fee isn't just the money you pay. It's the money that money would have earned for decades, compounding on itself. That's what you lose. And 41% of 401,000 participants don't even know they're paying fees. They have no idea money is being extracted from their retirement every single year. Here's another one: target date funds. These are the set it and forget it retirement funds that automatically adjust as you get closer to retirement. They're the default option in most 401k plans. The average target date fund charges 0.43% in fees. Vanguard's target date funds charge 0.08%. That's an 81% difference. And 75% of people who are automatically enrolled in their 401k never change from the default option. They just leave it wherever it landed for their entire career. Default settings are costing people hundreds of thousands of dollars in retirement because nobody bothers to log in and make a change. Now let's talk about mortgages, because this one is wild. Shopping around for a mortgage saves an average of $80,000 over the life of the loan. $80,000 just for getting multiple quotes. But 1/3 of home buyers only get one mortgage quote. They apply with one lender and accept whatever rate they're offered. And 77% apply with only one lender total. They don't shop around at all. Let me show you what rate differences actually cost. On a $400,000 mortgage, the difference between 6.5% and 7% costs $47,859 over 30 years, half a percentage point, $48,000. A quarter point difference, $23,811. A full point difference, $96,694. You could buy a car with the money you'd save by getting a slightly better mortgage rate. But most people don't even try. And here's the thing about mortgage rates: your credit score determines what rate you're offered. Someone with excellent credit gets around 6.45% APR. Someone with poor credit gets 8.05% APR. That 1.6% difference on a $350,000 mortgage costs $109,440 over 30 years. That's $304 extra per month for 3 decades because of a number on a credit report. Speaking of credit scores, let me show you the total lifetime cost of poor credit versus excellent credit. This is across all financial products combined. Mortgages, about $109,000 extra over 30 years. Auto loans, about $45,000 extra over a lifetime of vehicles. Auto insurance, $88,000 extra over 40 years of driving. People with poor credit pay 98 to 117% more for car insurance. Same car, same driving record, double the premium. Home insurance, $52,500 extra over 30 years. Poor credit means 71 to 137% higher premiums. Credit cards, about $9,000 extra over 20 years. Add it all up, poor credit costs $250,000 to $350,000 over a lifetime compared to excellent credit. And 31% of Americans not even know their credit score. They have no idea where they stand on the most expensive number in their financial lives. Let me talk about car loans because the spread here is insane. If you have excellent credit above 781, you get about 5.18% APR on a new car. If you have subprime credit between 501 and 600, you get 13.22% APR. That's an 8 percentage point spread on the same car. On a $40,000 loan over 60 months, the difference between 5% and 7% costs $2,234 extra. The difference between excellent and poor credit cost over $9,000 extra per vehicle. Over a lifetime of 5 vehicles, poor credit borrowers pay roughly $45,300 more just in auto loan interest. And only 50% of consumers even shop around for auto loans. Half of people just take whatever the dealer offers. Dealers mark up interest rates by an average of 1.08 percentage points above what the bank actually charges. That markup alone adds $2,109 to the average loan. For nothing, just for not shopping. Now let me tell you about the most passive way you're losing money right now. Your savings account. Chase pays 0.01% APY on savings accounts. Bank of America pays 0.01%. Wells Fargo pays 0.01%. Online high-yield savings accounts pay 4 to 5%. That is a 400x difference in interest rates. Not 4 times, 400 times. Let me show you what this actually costs. $50,000 in a savings account at 0.01% for 30 years grows to $50,150. You made $150. Congratulations. That same $50,000 at 4.5% for 30 years grows to $187,266. The difference is $137,116 on money that was just sitting there, doing nothing. And 96 million Americans have never switched banks. The average person keeps the same checking account for 17 to 19 years. Seniors average 26 years with the same bank. You're losing over $100,000 because switching banks feels like a hassle. The 20 minutes it takes to open an online savings account is worth $137,000. That's $6,850 per minute. Now let me talk about insurance, because there's a concept called the loyalty penalty that's absolutely wild. Insurance companies charge long-term customers 20 to 40% more than new customers for identical coverage. Same policy, same risk profile. You just pay more for being loyal. Shopping for car insurance annually saves $1,269 to $1,370 per year on average. That's potential savings of 32 to 77%. Shopping for home insurance saves $200 to $500 yearly. But 75% of people don't shop their car insurance annually, and 43% have never switched providers, ever. Over 40 years of driving at $1,300 per year in savings, that's $52,000 in unnecessary insurance payments for not spending an hour getting quotes. The companies know you won't leave. They literally build the loyalty penalty into their pricing models because inertia is that powerful. Here's one more. Credit card interest rates. Average credit card APR is now over 21%. Some cards charge 25 to 28%. If you carry a $5,000 balance at 24% APR and only make minimum payments, it takes 285 months to pay off. That's 23 years and 9 months. And you pay $9,332 in interest, nearly triple the original balance. But here's what nobody tells you. 76 to 83% of cardholders who call and ask for a lower rate actually get one. The average reduction is 6.5 to 6.7 percentage points. On a $7,000 balance at 27% APR, negotiating down to 20% saves $1,606 in interest and eliminates the debt 7 months faster. One phone call, maybe 15 minutes of your time, $1,600 saved. Let me add all of this up so you can see the total damage these small percentages cause. Not negotiating salary, $750,000 to $1.5 million. Investment fee differences, $500,000 to $2.8 million, depending on portfolio size. Not shopping for mortgages, $80,000. Credit score penalty, $250,000 to $350,000. Low savings account rates, $137,000. Insurance loyalty penalty, $52,000. Credit card rate differences, $10,000 to $20,000. Small bank and convenience fees, $50,000 to $130,000. The total potential lifetime cost of ignoring these small percentages is somewhere between $500,000 and $1.5 million. For most people, it's more than they'll ever earn from any single investment. And every single one of these is fixable today. You can negotiate your next raise. You can check your 401k expense ratios in 10 minutes. You can open a high-yield savings account this afternoon. You can get insurance quotes this weekend. You can call your credit card company right now. None of this requires special knowledge or connections or luck. It requires knowing that 1% matters, that 0.5% matters, that the tiny numbers are actually the biggest numbers in disguise. The financial industry is designed to make these percentages invisible. Fees are buried in documents. Rates are quoted in ways that sound small. Everything is structured so the 1% drains away before you notice it. Your job is to notice it. The difference between someone who builds wealth and someone who doesn't often isn't income or luck or inheritance. It's attention to the small percentages that compound over decades. 1% per year for 40 years isn't 40%. It's the difference between retiring comfortably and working until you die. It's the difference between options and obligations, between freedom and dependency. The most expensive decision you'll ever make isn't buying a house or choosing a career. It's the 1,000 small moments where you accepted the default, took the first offer, didn't read the fine print, didn't make the phone call, didn't shop around. Those tiny decisions compounded into a fortune, just not your fortune. But here's the good news. You can start fixing this today. Pick one thing from this video: the expense ratio check, the insurance quote, the salary negotiation prep, the high-yield savings switch. One small action. That's how you start reversing the 1% drain. Because if 1% can cost you $1 million, it can also build you $1 million. The math works both ways. If this video showed you how the small percentages are actually the big decisions, hit that subscribe button. I expose the hidden math of money every single week. Comment below and tell me which one of these surprised you the most. Was it the salary negotiation, the expense ratios, the savings account gap? I want to know which 1% you're fixing first. All right, go find your percentages. I'll see you in the next one.